In this week's Property Insider chat, Dr. Andrew Wilson and I discuss some of the latest news that would suggest that interest rates aren't going to drop anytime soon. Now, that's a bit of an unfortunate news for those interested in the housing markets, but there's also lots of positive news that we discuss, including the latest home lending figures, what it costs to build a house, auction clearance results, and some general thoughts on where our housing markets are going to be later on this year. If you want to keep up to date with what's happening in our real estate markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. Let's look at some of the clues in the news for what's ahead for property. Just as last year, 2023, defied the forecasts of many economists and the news media, delivering solid growth around property markets in Australia, it looks like this year, 2024, is going to surprise many of those who made forecasts earlier in the year. Our housing markets finished the first quarter of the year generally much stronger than many were expecting. Rents have kept skyrocketing, and those who forecast falling interest rates, well, they're changing their minds now. Each week, Dr. Andrew Wilson and I look for clues in the news. They're going to give us an indication of what's ahead, and today's no different as we discuss what's happening to finance approvals, the cost of housing, and our auction markets. And as I said, these statistics will give us some clues to what's ahead. So welcome, Andrew.
Yeah, good day, Michael. And I don't want to start off as we usually do in terms of when you mentioned the forecasting errors that we're becoming very used to. It almost becomes tiresome to hold to account those who make all the clickbait forecasts, and then sooner rather than later they're backtracking and back to, reality. But it was an interesting week last week. The prospects of lower interest rates currently in Australia are laughable. And those that are making those forecasts really should be held with their feet to the fire to some degree. Last week, of course, we had the latest US inflation data out. The US forecasters and economists who really should be embarrassed with their performances are now backtracking very strongly because the data is just not supporting and really hasn't supported their point of view. And with roaring economies, the very sense of cutting interest rates at this point, given that inflation is still ahead of the target range and that we have a lot of black clouds on the horizon in terms of the key drivers of inflation, and we're particularly talking the price of oil, but also undersupply of housing is continuing to push, as you mentioned, rents up. It's just really no sign of those factors improving to the point where we would actually think about cutting interest rates. And let's just mention, finishing off on interest rates, Australia's official interest rates now are still the best part of 1% below where they were at the previous peak of the cycle in 2011-12. So it's just more nonsense from the media, more nonsense from those that really either don't know what they're talking about or are just looking for cheap headlines. But we should move on.
Before we do that, Andrew, the unfortunate circumstances that are happening in the Middle East are only likely to increase the price of oil, and you've regularly shown us the relationship between the price of oil and inflation. So that's another negative for inflation coming down in the next little while.
Yeah, that's right, Michael. And we broke through the $90 US a barrel price for oil a week or two ago, which is a resistance barrier. If we move above $90 US, we'll probably quickly get to 100, and then we'll start thinking about a $3 a litre petrol price here in Australia, which is just disastrous. But it's now exacerbated by these issues, as you mentioned, in the Middle East. We've still got plenty of work to do to get inflation under control. The sad story about inflation is very, very simple for those who think they're economists out there, that it's all about the mismatch between supply and demand. You either reduce demand or increase supply. We're really constrained about increasing the supply of oil or housing. So it means we've got to reduce demand. And the key measure, as we know from history, to reduce demand is higher unemployment. An unemployment rate with a 3 in front of it, which we have and the US have, is miles away from what we need to get the type of demand, unfortunately, that we need to stop people spending. So long way to go before we should be realistically speaking about cuts in interest rates. And of course, we'd like to see that, but we have to have the data to support it. And we're just not there at the moment, Michael.
Well, getting onto our housing markets, we keep a careful eye on the home lending approvals because this is a good indication of what's likely to drive our housing markets in the months ahead. And the latest figures came out for February, Andrew. What did they show?
Yeah, look, an uptick. We shouldn't be surprised. We had home loans falling over January and December last year, Michael. This is seasonally adjusted data, and yet our markets were still ticking over. But nonetheless, we've seen a bounce back over February with home loans rising by 1.4%. We should shout out or point out that the ABS has had some issues with their seasonal adjustment modelling, particularly in the home loan data. But nonetheless, it does support, as you mentioned, the strong start to the year that we're seeing with other indicators such as house prices and auction clearance rates. So home loans up by 1.4% over the month, again, validating what we can see with other factors in the housing market. When we look at the breakdown in buyer types, we can see that all buyer types increased over the month: investors, owner-occupiers, and first home buyers. Of course, first home buyers have been quite active regardless over the last 6 months or so, certainly over the past quarter. And no surprise there, given high rents, higher house prices, and higher prices generally are certainly motivating first home buyers to get into the market even sooner than they're normally motivated, Michael. So yeah, look, some positive data there for home loans, not a surprise, and more positive news for first home buyers. Again, we shouldn't be surprised at that as well. I've introduced another slide, Michael, just to when we're talking about new housing and how important that is, not just for our housing market in terms of trying to moderate rental growth, particularly. I've looked at the relationship between loans for new housing and loans for established homes. And it's interesting that with the falling in building approvals that's continuing, Michael, we're still seeing a decline in the relationship between loans for established homes versus loans for new housing, which is another negative sign in terms of us improving our supply line for housing. And when we look at that actual percentage factor, the percent of new home loans versus established homes, it's fallen from a peak back in 2021 when, of course, we had that previous government's home builder policy, which created a lot of demand for new housing. It peaked there, that proportion of new housing to established home loans at 38.6%, but now we've fallen down to just 19.9%, Michael, which is a very low number historically, and it just reinforces just how subdued new construction is at the moment.
On the other hand, Andrew, investor loans went up 1.2% in February. In fact, the value of investor loans in February was 21%, 21.5% higher than a year ago. So it seems like investors are getting back into the market.
Yeah, look, it was a general upswing in activity from owner-occupiers and investors, Michael. And yeah, I think that it just reflects what we can see with other data, such as auction clearance rates and home prices.
Well, you were mentioning about new homes, and one of the factors involved is the cost that new dwellings, whether they're homes or apartments, are much more expensive now. So I know my housing market keeps a regular track of home building costs. They got a bit out of hand over COVID and created a lot of havoc in the building industry. What are the latest figures shown?
Yeah, look, as I mentioned before, the previous government's home builder policy created a lot of demand. We didn't have the supply to match it. So that pushed up house building costs particularly, and that's a key factor. Rents and house building costs are the factors that contribute to the housing section of the CPI, of our inflation data. So it is important to keep an eye on that. That is the big picture here in relation, as we've already discussed, the interest rate outlook. And when we look at the latest data, it was interesting. The previous month's My Housing Market House Building Cost Index actually showed an uptick, which was a little concerning after some lower trended growth over the with the year annual trend. But some better news, Michael, is we saw a fall with the February index. It fell down compared to January. So some better news there, and reinforcing what over the longer term has been a declining trend. And the good news when we talk about the trend, and it is the annual costs of the quarterly house price index that are important in relation to its contribution to the CPI, down to 5.6%. So annual quarterly house building costs are now increasing by 5.6% over the year to February, Michael. Now that's well below the 22.7% extraordinary increase we had at the peak of that supply-demand mismatch, and it's certainly the lowest we've had in this cycle. And still of a concern to the industry, of course, is costs rising at 5.6% annually, because we are well ahead of where we were in that typical pre-COVID environment, where building costs were certainly rising around about 2 or 3%. But we're heading in the right direction, Michael. This is good. It'll help profitability for builders and certainty for builders. So let's hope that trend does continue. That will allow, us to reinvigorate our supply line, which we sorely are in need of doing. We also do for clients the capital city-based changes in house building costs. We can see there's some mixed results when we look at the annual change. We can see the quarterly change is certainly downwards in all capitals, and that reflects what we saw with the overall results nationally. And this is capital city. National covers the whole of the spectrum, not just capitals. We can see when we look at the annual growth that Sydney's actually the leader. Its house building costs have increased by 9.9% over the past year, just remembering that the national result is 5.1%. Melbourne quite steady there, but we know Melbourne has a much stronger supply line of housing. It provides 40% of all new housing, capital city housing. Brisbane, strong market there. We know plenty of demand for housing in Brisbane, up 4.6% over the year. Adelaide and Perth a little lower. Adelaide down 1.6%, Perth up 3%. So interesting to compare the capital city house building cost indices, Michael, and just showing how strong that Sydney market. But we know it's much tougher Sydney develops a much smaller proportion of houses compared to the other capital cities. It's more about units in Sydney. And when we look at the relativity index, which looks at the comparison of house building costs, we can see when we base Sydney at 100 that it's well ahead in terms of its average house building costs from the other capital cities, nearly 25% higher than Melbourne and well above Sydney, Adelaide and Perth. So a very expensive place to build a new home in Sydney, certainly building costs. But we know that already, Michael, from the actual price data for the finished product. But the building costs are certainly significantly higher in Sydney compared to the other capital cities.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process. It's not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Well, each week, Andrew, we dissect the auction results because they give us a good in-time indicator of both buyer and seller sentiment. Of course, high auction clearance rates are a good indication that moving forward, property values are likely to rise. But so far this year, Andrew, you've analysed how many auctions there were compared to a year ago. Boy, there's been a surge in auction sales, hasn't there?
Well, there has, Michael. And of course, this is April, which is the holiday month. We've had an earlier Easter, but we're now well and truly into school holidays. All our states have school holidays at the moment. We've just started with some of the states and we're midway through some of the other states. So it is a distracted market. Of course, we see lower numbers of listings and a differential in the type of properties that are going under the hammer. We see a much lower proportion of higher priced properties being auctioned through the school holiday period. So we need to take it a little bit with a grain of salt, our results. But results really held up again this weekend, Michael, despite those school holiday distractions. And auction numbers were still significantly higher than at the same period last year, which was still school holiday time. So Sydney had 750 auctions, well ahead of where it was a year ago, certainly lower than the previous weekend, which was a non-holiday weekend. Clearance rate around about the same as the previous weekend, Michael, 71.8%. As I mentioned, the proportion of higher priced properties in Sydney going under the hammer was much lower, because of that holiday impact. But again, a good result there for Sydney. Melbourne, basically the same weekend on weekend. Auction numbers were higher and similar to Sydney, well ahead of where they were a year ago, and a similar clearance rate to the previous weekend. Melbourne not performing as strongly as the other markets, but a reasonably steady market there in Melbourne. In fact, when we look at the breakdowns, which we get with the regional report that we publish every week, we can see actually units are performing quite well under the hammer at the moment, and certainly at higher levels than houses. Brisbane, 67 auctions with holidays there in Brisbane, a little lower than the weekend before. Good clearance rate for that Brisbane market, which always tends to have lower clearance rates. And again, the numbers were higher than a year ago. Adelaide, school holiday influence, 52. But back to the 80s and nearly 90s for Adelaide, Michael, 89% clearance rate, which is similar to where we saw a year ago. And that super auction energy in Adelaide's been a little bit missing this year so far, although auction clearance rates have been consistently higher than most of the other capitals. It haven't been at those 80% plus rates, but the exception was last weekend, where we're back to an 89.1% clearance rate. And Canberra picked up a bit with auction numbers down a little bit compared to the previous weekend, but just under 60%. And Canberra has been showing clear signs of breaking free from the stagnant market that we had through the second half of last year in Canberra. When we look at the trends over April so far, auction clearance rates in Sydney are around about the same as where they were a year ago. We've got to remember, Michael, that markets started to accelerate a year ago because a lot of that pent-up demand that was created through 2022 was starting to be released as confidence returned to the market. I don't expect to see the same sorts of results through the late autumn winter period that we had last year because a lot of that pent-up demand is dissipated. But I still think auction results in most capitals are going to clearly favour sellers going forward. Melbourne below where it was a year ago. As I said, the Melbourne market was starting to accelerate a year ago as that pent-up demand was released. Brisbane a little bit lower than where it was a year ago. Adelaide similar to where it was a year ago. And the Canberra market tracking a little higher or just about the same as where it was a year ago as well, Michael. So, and as I said, some early signs that Canberra market is picking up this year, but the next few weeks will confirm that that Canberra is in revival mode. You did mention that we've been looking at some other measures of auction activity this year, which sort of puts the whole story together, not just clearance rates and the number of listings. We're looking at the number of actual sales, auction sales, Michael. And we have had record numbers of listings for this time of the year in most of our capital city markets. And clearance rates have been certainly positive, although, as I said, likely not to get to those very strong results that we had going forward through May and June last year. And nonetheless, we're recording the highest auction sales on record, or near the auction sales on record for Sydney and Melbourne and Brisbane. Auction sales over the February to April period so far this year in Sydney are up 40%. Compared to the previous year, or compared to last year. Melbourne up nearly 20%, Brisbane up 26%, Adelaide up 4%, and Canberra still underperforming, down 4.5%. But as I said, we're seeing some better signs for that Canberra market potentially coming through. But I think that tells the story that plenty of buyers out there, Michael, and they're not being really sidelined by these high listing numbers that we've seen for this time of the year. So again, correlating with what we've seen with the other data in terms of higher prices and rising home loans. Of course, you can get those auction clearance rate results on my LinkedIn account every Saturday at around 6:30 for the National Capital City Snapshot. And Sundays, Michael releases the full national report, which includes the regional breakdowns for Melbourne and Sydney and the top prices, the top 10 prices in each of the capital city markets. So look out for that one.
Sure. Well, it's interesting because when an auction sells, there's two or three other bidders who've missed out. They're coming out next weekend, again, a bit disappointed, a bit more motivated. Vendors see properties selling around them, and they're not going to expect to sell their property for less. Everyone thinks their property is better than their neighbours, and it is a bit of a snowballing effect. There's a little bit of FOMO creeping in certain of the markets, particularly in Sydney, where auction clearance rates remain very high, and definitely in Adelaide. All that seems to suggest we're going to continue having a good year for property in 2024, Andrew.
Yeah, look, perhaps a steadier year, Michael. And I think the only grey cloud on the horizon is the outlook for inflation. I wouldn't be making any decisions based on lower interest rates going forward. The markets are steady at the moment. Housing markets are performing well. It's still, in my opinion, and the data supports it, a seller's market. Plenty of competition, as you mentioned, Michael, amongst buyers for property. We are chronically undersupplied. So I think it's a steady market going forward. And as I said, I think we're not going to get the results we had through the end of the autumn season last year, but that was because of all that release of all that pent-up demand from the negative year we had in 2022. So I think the prospects are still quite positive going forward for our housing markets, Michael.
This is a much more balanced
Yes.
control. You can't have double digit. We'd like it as homeowners and investors, but that's unhealthy because having double digit growth for too long just leads to the next downturn. Let's have a gentler growth market, Andrew.
Yeah, and look, we can't have that because our incomes don't support it. And we're protected from overreaching in our housing markets because banks won't lend beyond their barriers, 25% deposit or 20% deposit, 80-20 LVRs, and they won't let you pay more than 25% of your income in repayments. So that just keeps a cap on that growth rate. And that's what we're moving back into now. But the positive for that is we've got wages growing at record levels at the moment and a full economy. So everybody's sort of got a job who wants a job and wages are rising. So at least we have the capacity to continue to pay more with a strong economy. We're just not going to be able to pay 10 or 15% more. But there is some upswing, I think, upswing potential for perhaps 10% growth in some of those smaller markets such as Adelaide, Brisbane and Perth, because their income's actually on a par with Sydney and Melbourne, and yet their house prices are significantly lower at this point than Sydney and Melbourne. So they have an affordability advantage, which means they actually can borrow more, Michael. This is probably going to fire up those markets, and we've seen that certainly so far this year, to maybe even reaching double-figure growth this year. But we're pushing ourselves ahead. But certainly I think we'll have positive growth in most, if not all, of our markets this year. We're off to a very, very strong start.
Great. Well, look forward to catching up with you again next week and hear all the clues in the news. Speak to you then.
Thanks, Michael.